What's up everybody, it's Raj, and today we're diving deep into the world of Indian stocks. Specifically, we're talking about the Nifty 50 India's version of the S&P 500. Now you might be thinking, Raj, why should I care about the Nifty 50? Well, my friend, India is one of the fastest growing economies in the world, and their stock market is on fire. But here's the thing, not all stocks are created equal. Some might be overvalued while others are hidden gems just waiting to be discovered. We're talking in-depth analysis, folks, looking at things like price-to-earnings ratios, future growth potential, and comparing them to their industry peers. So, buckle up, smash that like button, and let's dive into the exciting world of Indian stocks. Alright, before we jump into specific stocks, let's get a feel for the overall market sentiment. Understanding the broader market context is essential for making informed investment decisions. You see, just like checking the weather before heading out, it's crucial to understand the market climate before making any investment decisions. This helps in anticipating potential risks and opportunities. As of right now, the Nifty 50 index is trading at a price-to-earnings (PE) ratio of around 20.5 times. This metric is often used to gauge whether a market is overvalued or undervalued. Now, that's slightly higher than its long-term average, which might make some investors nervous. A higher PE ratio can indicate that stocks are more expensive relative to their earnings. But here's the thing, averages don't tell the whole story. Market dynamics are influenced by a variety of factors, and it's important to look deeper. While some sectors within the Nifty 50 might be looking a bit pricey, others are still trading at attractive levels. This sectoral variation can offer unique investment opportunities. Think of it like a buffet. You wouldn't judge the entire spread based on one dish, right? Similarly, it's essential to evaluate each sector on its own merits. So, what are the key market trends influencing these valuations? Understanding these trends can help in making more strategic investment choices. Well, first off, we've got the Reserve Bank of India's RBI monetary policy. Their stance on monetary policy can significantly affect market liquidity and investor sentiment. Their decisions on interest rates have a huge impact, especially on financial stocks. Interest rate changes can influence borrowing costs and consumer spending. Then there's global inflation and interest rate trends, which can create volatility in the market. These global factors can affect investor confidence and market stability. That's why we're going to analyze the top stocks sector by sector, looking for those hidden gems with solid fundamentals and strong future potential. By doing so, we can identify the best investment opportunities in the current market landscape. Now let's talk about one of the pillars of the Indian economy, the banking sector. This sector has been a cornerstone of India's financial system, driving growth and stability. Now India's banking sector is like a well-oiled machine, showing consistent growth in credit demand. This growth is fueled by increasing consumer confidence and expanding economic activities. But that doesn't mean all banks are created equal. Each bank has its own strengths and weaknesses, and it's crucial to understand these differences. So, let's break it down. We'll look at some of the major players in the Indian banking sector and see what sets them apart. First up, we've got ICICI Bank. This bank has been a significant player in the market for years. They're like the cool kid on the block, strong fundamentals, a leader in digital banking, and their valuation, still very reasonable. Their innovative approach to banking has set them apart. They've been consistently growing their profits, and their focus on technology gives them an edge in the digital age. This focus on tech has made banking more accessible and efficient for their customers. Next we have HDFC Bank, known for its robust performance and customer-centric approach. They recently went through a merger, and while mergers can be tricky, this one seems to be working in their favor. The merger has expanded their reach and capabilities. They've got solid asset quality and are known for their efficiency. Their ability to manage assets effectively has been a key to their success. And of course, we can't forget about the giant SBI, the State Bank of India. This bank has a massive network and a significant impact on the economy. As a public sector bank, they're backed by the government and benefit directly from India's economic growth. This backing provides them with a level of stability and trust. Always do your own research and make sure the investment aligns with your risk tolerance and financial goals. Understanding the nuances of each bank can help you make a more informed decision. Now let's talk tech, specifically Indian IT. We all know the tech sector took a bit of a hit in 2023, but you know what they say? What goes down must come up, right? And that's why I think some of these IT stocks are looking mighty attractive right now, especially after the correction. Take Infosys, for example. They're like the veterans of the Indian IT industry, with a client base that reads like a who's who of Fortune 500 companies. And guess what? Their valuation is looking pretty reasonable after the recent dip. Then we have HCL Tech. They're known for their strong earnings visibility and their focus on the future of tech, cloud computing, and artificial intelligence. These guys are not afraid to innovate, and that's something I look for in a long-term investment. However, remember, tech is a fast-paced world. That's why it's crucial to stay up to date on industry trends and make sure the companies you're investing in are adaptable and innovative. Now let's talk about those stocks that your grandma probably loves, the FMCG sector. These are the companies that produce the everyday items we all use, from the moment we wake up to the time we go to bed. FMCG stands for fast-moving consumer goods. Things like soap, shampoo, toothpaste, the essentials we can't live without. These products are always in demand, making the sector a stable investment choice. Now, these companies are considered defensive plays because no matter what's happening in the economy, people still need their daily essentials, right? Whether it's a boom or a recession, the demand for these products remains relatively constant. But the question is, are they still worth investing in? With changing market dynamics and consumer preferences, it's crucial to evaluate their current standing and future potential. Well, let's start with the king of Indian FMCG ITC. This company has a diverse portfolio that extends beyond just consumer goods. They're like a conglomerate, with their hands in everything from cigarettes to biscuits to hotels. This diversification helps them mitigate risks and capitalize on various market segments. And despite their size, they're still growing their FMCG business at a healthy pace, and their valuation is relatively fair compared to their peers. This makes them a strong contender in the market. Then we have Hindustan Unilever, the Indian arm of the global giant. Their brand recognition and market reach are unparalleled. They're known for their premium product portfolio and their wide distribution network. This extensive reach ensures their products are available to a vast consumer base. However, their valuation is a bit on the higher side, reflecting their market dominance. Investors need to weigh this against their growth potential. Now, FMCG companies are typically valued based on their price-to-earnings (PE) ratio. This metric helps investors gauge whether a stock is over or undervalued. But here's the catch: high valuations also mean higher expectations. Companies need to consistently perform well to justify these valuations. So, even though they're considered defensive plays, it's important to analyze their growth prospects and make sure their valuations are justified. Always do your due diligence before making any investment decisions. Alright, let's shift gears and talk about the auto sector. Now, the Indian auto industry is going through a massive transformation right now, with rising demand and the electric vehicle revolution taking center stage, and that's creating some interesting opportunities for investors. First up, we have the undisputed king of the Indian roads, Maruti Suzuki. They've been the dominant force in passenger vehicles for decades, and they're not slowing down anytime soon. They're also making moves in the EV space, which is crucial for their long-term growth. But the real story here is Tata Motors. They've been killing it lately, with their JLR, Jaguar Land Rover brand making a strong comeback, and their EV segment growing like crazy. When it comes to valuing auto companies, we look at their forward PE ratio, which takes into account their expected earnings growth. With the EV revolution just getting started in India, I believe companies like Tata Motors, with their early mover advantage, are well positioned for long-term growth. Now let's talk about the backbone of any growing economy: infrastructure. India is on a mission to upgrade its infrastructure, and that's creating a ripple effect in related sectors like metals and construction. Leading the charge is Larsen & Toubro, or L&T as it's commonly known. They're like the construction giants of India, with their hands in everything from roads and bridges to power plants and airports. And with the government pouring money into infrastructure projects, LT's order book is overflowing. Then we have Tata Steel, one of the world's leading steel producers. Now, steel is a cyclical industry, but with global demand remaining strong, Tata Steel is riding high. Their margins are looking good, and their valuation is reasonable. Now, when it comes to valuing infrastructure and construction companies, we look at their PE ratio and their order book. However, keep in mind that these sectors are heavily influenced by government policies and commodity prices, so it's essential to stay informed and factor in these risks before investing. Last but not least, let's talk about the energy and utilities sector. Now, this sector might not be as flashy as tech or auto, but it's the backbone of any economy. And in India, we've got a mix of traditional energy giants and exciting new players in the renewable energy space. First up, we have Reliance Industries. They're like the 800-pound gorilla of the Indian stock market, with their tentacles in everything from oil and gas to telecom and retail. But what's got me excited is their push into green energy. They're investing heavily in solar, batteries, and hydrogen, positioning themselves as a leader in the clean energy transition. Then we have NTPC, India's largest power generation company. They're a public sector undertaking, which means they're backed by the government. Now, energy companies are typically valued based on their PE ratio and their dividend yield. So it's crucial to consider a company's long-term strategy and their ability to adapt to this changing landscape. So, which Nifty 50 stocks look the most attractive right now? Well, after analyzing the market, looking at valuations, and considering future growth potential, I've got my top 3 picks for 2025 and beyond. First up is ICICI Bank. They're firing on all cylinders with strong fundamentals, a solid digital strategy, and a reasonable valuation. Next, we have Tata Motors. They're riding the EV wave, their JLR brand is back on track, and their stock price is still undervalued. And finally, we have NTPC, a PSU powerhouse with a juicy dividend yield and a bright future in renewable energy. But remember, the key is to do your own research, diversify your portfolio, and invest for the long term.